Well, welcome everybody to today's class on trading a smaller account. I'm Connie Hill. I'm subbing in for Barb Armstrong while she's going through knee surgery recovery, and things are going along well with her. She's hobbling along ahead of schedule, is what we've learned about her. In this particular class, we work with different parameters that we might not in other classes because it is a smaller account. Now, I'm going to ask you guys how many, and I want you to answer this in the chat, how many of you use implied volatility levels and beta to help you decide maybe what strategy to use? We're going to incorporate that into our discussion here today, see how that might help you as you do so. Now, we've got some friendlies out here. Want to say a quick hello to Paul, APA, Will, Janet, Sharon, Jack, Priya, Rocky, David, D. Womack, Life in the Fast Lane, TT or TM, and a whole bunch of you. I'm glad to see that you're here today. We are joined in the chat by Brent Moores. Happy that Brent's here. He is a master at all the strategies that we might be discussing here today. As you have questions, go ahead, let us know. I'll keep my eye on the chat, but Brent will also keep an eye for maybe some of the things that I can't quite get to. All right, so there's that. Make sure you're following us on X. I'm Connie Hill CS. Brent is Brent Moore CS, and we'll post educational content out in our X account. It's free to follow us. We'd love to have you get in on those little nuggets that we share with you. Let's go through our disclosures and then we'll get into our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today should be information and education purposes. Don't consider it a recommendation. We will be using the Paper Money software application. That's the most robust version of Thinkorswim. Has a lot of nice tools for option traders, which we do quite a bit of in this class. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. Now, Priya says, I don't use those. I asked if you used beta or implied volatility to help determine what strategy you might consider using. And Priya says, I don't because I only do a short put or a short vertical strategy. We'll talk about that a little bit here today. And so it could be a factor that you might use, and it might not be. Typically, we'll take a look at what the markets are doing. We're have kind of a flat day in the markets, although we still have higher highs and higher lows as far as the major trends go with the indices. We're always going to do some new example trades. We're going to follow up on a couple of trades. Got a pretty packed agenda for us today. Now in this class, we have a $20,000 Paper Money account. Your account might be bigger. It might be smaller. Okay, but we're using restrictions for a $20,000 account here for our position sizing. And so we don't want to hold any position more put more than $5,000 into it, right? That will wrap up a chunk of money in our account. Max risk that we're willing to take is $400 to $500. That's the most we're willing to risk per position. And you think about that and you're like, well, if I was wrong 5 times in a row, ooh, how bad would that be? Well, that'd be kind of painful, right? If you were wrong 5 times and we were risking $500, that's $2,500 out of a $20,000 account. Yeah, that's more than 10%, so that would be sizable. So we want to keep our risk small. And really, we don't want to lose that amount of money, but we've got to risk something to be able to put on our positions. We focus mostly on shorter term timeframes and intermediate timeframes. We're going to look at both bullish and bearish conditions. Bullish strategies that we have been using, will continue to use, are those listed stocks, calls, short puts, buy right cover calls, short put verticals, long call verticals. All of those are in play. In bearish situations or bearish market conditions, we may consider doing long puts, long put verticals, short call verticals. And sometimes we'll talk about iron condors and calendars when we're in conditions or come up with some stocks that kind of meet those conditions. Yeah, we're going to talk about and use those strategies here as well. Now, somebody had a question here. I want to go back here and find it. LD says, is there a way to set a stop based on the moving average, for example, if it crosses below? The answer is yes. There is. There's some different studies. In fact, when we pull up an order, maybe I'll show that to you, how you can have it be based, instead of being something on price, that it can be based on a study. Okay, that is absolutely possible. Now, what I'd like to do is first take a quick look at a couple of our trades and see where they are, because we've got a lot that we've been doing, right? We meet Mondays and Fridays, so we've got quite a few trades on. I want to show you what happened to a couple. I'm going to tell you most of them are just working right now. All right, they're in work on, let them run mode here. We talked about market conditions. SPX is up, right? Right now it's up 0.24%. So it's kind of like marginally up. It's not like a strong bullish day, but the trend, man, it has stayed well above this 10-period blue line, that moving average. It has quite well. And what did it do? Today it's already put in another new high, all-time high. Same thing on the NASDAQ, a new all-time high. And it's kind of like these indexes, stocks in them, just kind of keep churning, right? Hitting a little bit new high, a little bit new high. It's not like we're seeing real big candle action and real volatility, but it's just kind of a grinding out sort of thing. Looks like the NASDAQ is up about 0.26% right now. And the VIX, the volatility index, that's our fear factor. Are people skittish on the market? Are they not? When the VIX is up, we know our put call ratio, they're buying a lot more puts than they are calls, which means protection oriented, right? And here on the VIX, hey, it's dropped down. Looks like it hit a low yesterday, 1495. Right now it's about 15. All right, on the volatility index, which is, you can see, kind of lower. It's not as low as we could go, but we're in relatively low volatility conditions. What's that going to mean to you? Well, it's going to mean to you that option premiums, which we use a lot of option strategies in this class, option premiums overall might not be quite as expensive. They might not be quite as rich if you're selling, like PRE is selling puts and put spreads. But there still can be some stocks that have higher implied volatility, and we're going to focus on that a little bit here today. Paul says he takes the stairs going up, right? And then watch for the window, like dropping out of the window, falling out. Yeah, sometimes those pullbacks can be swift and hardy. Journey says, what's the best option strategy for the churning mode? Well, because it's the market itself is in an uptrend, we're going to consider bullish strategies. And then many times it depends on what the stock looks like. If it looks like maybe it's going to make a big move or a smaller move. And we're going to determine more based on that, our expectation for stock movement, what kind of strategy we might want to use. Love that question. Thanks for bringing it up. As we come over here to the positions we've got going on in our account, some of these we did last Friday, some of them we did on Monday. A couple we're going to pull up and just kind of see where they're at. Let's start with Amazon. We did a long call vertical on Amazon on Monday. I actually don't have this marked up very good here. We did a long call vertical, and it got us out of the trade yesterday. Okay, so if we zoom in here, let's see. This is the 21st. That was Monday when we met in class, and we put on that long call vertical on Amazon. And we just wanted it to kind of keep going the direction it was. And yesterday, as it made this big run up here earlier in the day before it pulled back, it went ahead and put in and hit our predetermined target. All right, so our predetermined target on that on Amazon, this is a kind of an interesting one. We bought it for $1.30, and it was a $2.50 wide spread. So we were risking $1.30 to make $1.20, right? Because the difference in the strike prices minus your credit is what your max theoretical gain could be. We said, hey, if we get a chunk of it, we want to get out. So our chunk was at 214. Now, interestingly enough, it wasn't first thing in the morning. It was like market had been open for about 25 minutes when it executed our trade, but it gave us a pretty, I'm going to say generous. It gave us a very generous price here at 330. Okay, so we weren't looking for that much. Typically, we're not looking for more than the difference in the spread. We're not typically looking for more than 250 because theoretically it shouldn't go that high. But there will be some pricing you'll notice in paper money, especially Not usually as generous in the open market, okay, that you'll see something like that. And so really, if we take 330 minus 130, we receive $2 or $200 per series of contracts. We had 4 contracts. And so that bumped our account $800. I want you to know that's not normal. And this is, I'm going to say, probably more the nature of a paper trading account than an actual account, but trade still holds. It did what we expected it to do. It did it quickly. Boom, we were able to get out with a chunk of our profit. All right, next one was Wells Fargo. We put Wells Fargo on as well on Monday. So here's the 21st. We got in here. Nope, here's the 21st. We got in here. It looks like maybe by the end of the day it had pulled back a little bit. We looked at it earlier in the day. This one hit its target in 3 days. Okay. Wells Fargo. So it hit, I believe it was right here on the 23rd. It went out even faster. Okay, boom, boom, boom. And we were out of the trade. Most of it was that big move it made on the 22nd. So on Wells Fargo, we go check out our numbers there. We put on a long call vertical again, because last week, remember, or Monday, we focused on, can we build our account just using one strategy? And so all the trades that we made were long call verticals. Okay, so we said we paid 51 cents, so $1 wide spread. We were willing to risk 51 to make 49. So almost risking $1 to make $1, which puts you in the neighborhood of about 100%, but it was just slightly lower than that. We said if we could get out at 81 cents, we would be happy campers. And we did get out at 82 cents. Perfect. All right. We made a profit on that. We had, let's see, 31 cents per contract, or $31. We had 10 contracts, so $310. Remember, we're never including commissions in here. You got to factor that in. We don't have the time to go through that math. But essentially, a decent little, I'm going to say a double. Amazon was a little unrealistic, but it would have been like a big slugger, right? I don't know that it was a home run with the bases loaded, but it was a substantial. This is more of, say, like a double, right? We're up 61% in 3 days, 300 profit to build our smaller account. And it's those little profits that you bring in that help build it up. All right. There's a couple that I want to look at here. First one is one that's not in as good of shape, BP, British Petroleum. We entered this trade. We bought a September option, and we did this on the 11th. So that was last Friday, 2 Fridays ago. So it's had 2 weeks to work. We were going to give it a little bit more time to go and hit its target. We just bought the single option for $1.63. We could do 3 contracts in our account. Right now it's down a little bit. If I go to our activity and positions, we're down about 165 on it, so we're down about 33%. Let's take a look at the chart. On this one, we saw an ascending triangle. We got in on the breakout of that triangle 2 weeks ago, and the expectation was that maybe the next major move might be the height of the triangle. So that's where our target is, up there, the top of this white line. Well, it ran, I don't know, maybe halfway there before pulling back a bit. Sometimes when we see a breakout entry, we will see it break out, maybe sometimes run a little bit, and then sometimes it'll come back and test the old resistance area and say, hey, are you my new support? Are you working as my new support? And so that looks like what it's doing right here. So yeah, we're down on a little bit. Are we overly concerned? No. However, the next move, hopefully, that it makes will be running up, and hopefully it'll get close up to this target that we would maybe want to get out on it. Okay, so that's kind of our plan with BP. Nike, we got in on Monday. I'm just going to show you the chart real quick here. On Nike, it's working. This one, we were a little bit more aggressive with our long call vertical here. We got in here and we needed the stock to move up to this area. I think that's 77.50 is the strike price that we sold. And so we want it to move beyond that. It's 75, 77.50. And I bet if I do this, right now it's not showing. I put in the little label there to show us what our trade was. We've got till August 15th on this, so we're not incredibly worried. It's up a little bit, but just not a ton yet. We're going to let it work. Verticals are trades of patience, whether they're long verticals or short verticals, and we want to use that time decay to our advantage. Okay. Let's see. Nora says, paper trading profits are very unrealistic. In your opinion, I have compared real and paper for more than a year. Sometimes that's true, Nora. Sometimes and that's why I pointed it out. Sometimes it's not realistic. I don't want you to expect you're going to get this great feel, because sometimes we don't. But in the Amazon trade, frankly, it did what we wanted it to do, went up to its target area, threw out the order for us, right? That, hey, if you get up to this point in the limit, let's go buy you back. And it did that. And so it executed for us. So I want to point that out. But you're right. Sometimes those prices, that's going to be, I'm going to say, a limitation of our paper money platform that might be less realistic. So yeah, you want to be aware of that. I completely understand that. Now, if it expires, it shouldn't be counted as a day trade, BT is asking. If you have a trade that you get in on, say, today, and we were to get out before the market closed today, yeah, that would count as a day trade. It would. But if we close it out tomorrow, it's not the same trading day, right? So it doesn't really matter what the hours are. If it just goes from one trading day to the next, then it's not counted as a day trade. All right. Let's look at some other opportunities that I'm seeing present themselves. First stock we're going to take a look at here is going to be CFLT. All right, Confluent is a stock. You can see it with the labels up here, kind of what it's done. Month to date, it's up about 10%. So it's been moving, right? It has been moving nicely. It has come down a couple of times to the 30-period moving average. That's the red line, which is just kind of a intermediate moving average on the shorter range of things. And what has it done? Well, it looks like, I was thinking the earnings had taken place. Okay, this may change things a little bit with what we decide here. I was thinking on this one to do a long call vertical with it. The earnings are going to be on July 30th. I was thinking they were a little bit further out than they are. That means after the market closes on the 30th, we'd want to be out of the trade. Now, there's time that this trade could execute by then. Some of you don't like to hold over earnings. And so you might say, I would not even venture into that because earnings are so close. We're going to go ahead and do the trade that I set up. We'll see if it still looks good. The trade I was looking at was doing just a long call vertical, looking for a little bit of movement, using the August options here. And I want you to see, this stock has only traded 2.2 million shares today, but look at the options open interest. Look at these thousands of contracts on both sides, the put side and the call side of things. And so what I was looking to do, what we're going to put on here, we were going to put on a 27.28 long call vertical. Right now, the stock is at 27.45, so we would want it to move about 55 more cents. Would like it to do that before they announce their earnings, and it might not. But let's go ahead. We're going to put in this trade. Now, this is a small enough premium that if you did not want to do a vertical, you might not need to. But notice the implied volatility here that's priced into these options. It's high, which means this stock has been a mover. So there's an expectation for movement that gets priced into the options. The other thing I wanted to point out to you today was, what does the beta look like? Okay, we haven't talked about beta for a while. Beta gives us an idea if the stock's a mover when the market moves or if it's slower. So it's gauged back to the SPX. And, just an average stock on the S&P 500, we will give that a rating of 1. And so if the stock moves 1-ish, like this one is just 1 and 0.01, so just a tiny bit more. The SPX moves 1 point, we would expect this stock to move a point and a penny. Okay, so I would say it's average as far as that volatility goes, as far as an average stock on the S&P 500. Okay, that could lead you to decisions of maybe what strategy you might want to use. In this one, where this beta is about average, volatility is in a higher range, which we kind of like because we like stocks that are moving, right? If we need this stock to move 55 cents, we do want it to be moving. Let me get my little marker off of there. Let's open up these options. Okay, go back to them again. We're going to do a 27.28 long call vertical here. We're going to buy it. You might not be familiar with this strategy or comfortable with this strategy. It just means this is the only strategy somebody could do. If somebody were practicing and maybe at this point they knew to buy a long call, you could buy a long call, right? Priya says, you know, I'm really working on short put verticals. That's the only strategy I'm working on right now. So Priya might go to the put side of things and see what possibilities might be there. On this, we are going to risk 45 cents to make 55 cents, right? $1 minus the strike price. So our risk here is 45 bucks per contract. If we can risk 400 to 500, I'm pointing over here at my scratch pad, and that's not right. 400 to 500 are the rules for this class. We're willing to risk that. How many contracts can we do? We could go right in the middle at 450, right? And that would be 10 contracts. Okay, that's actually what we're going to do. We're going to go right in the middle, 450, not exceeding $500. And then we're going to do a first trigger sequential. We're going to put in an order. If we get a chunk of that 55 cents, we want to get out of the trade. And so let's use our little calculator here. If we can get out of our 55 cent max theoretical gain, suppose we can get 70% of that before they go through their earnings next week, and it executes for us automatically. That would be nice. If not, we'll probably just manually get out of the trade before they announce earnings. But if we can get out at, say, 70%, then I'm going to multiply this by 1.7. The 100 is so we're counting all of the 45 cents. The 70 is for that 70% chunk that we want of the 55 cents. And so that says go buy it back at 93. So we're just going to pop that in here. We would like to get out at 93 cents. Looks like I need my decimal there. We're going to make it good till canceled. Okay, and we're going to track it. Let's go ahead. We're going to put this in our trade in a smaller account bucket, send it on its way. And it looks like we might have a couple of questions out here that possibly I may need to tackle here. Let's see, Paul said, you know, hold too long and Ivy Crush gets you. If I think what you're talking about, Paul, is after the earnings announcement comes up, the volatility does. It comes crushing out of those options. And you could see here, the ones that had the most implied volatility priced into it were these that expire here in August. Okay, so you're right. When that earnings comes out, then it's going to scrunch down. And usually by the end of the day or the next day, yeah, it's back into these levels where these other ones are at about 63% or 60%, something in that range. Absolutely right. Now, some of you were concerned about trying to find the beta. Okay. Christina wants to see how we can put a stop on a put credit spread. I'll show you that, Christina. All right, we will show you. If you're not seeing the beta, it's because this little caret right here has to be clicked and expanded. Okay, so you click on that, it gives us this additional row, shows us the yield, and shows us what that beta is. Now, I do have a trade here. We'll go to it next. You guys seen this little stock that's been flying around? Joby Aviation. Now, I want you to see where it's been. Okay, this is a 3-month chart. So we're just going back to May. Stock down here, it looks like the low was about $6.14. And this stock is just like exploded here recently. You can see about right here, volume moved in, and look at all the volume we've seen on this stock since that period of time. And what's it doing? Man, it is driving the price up higher. This is one of those kind of stocks that maybe it's not pulling back for very long and you're trying to find a spot to get in. To me, this is what this looks like. It looks like it came back, kind of came close to the 10-day, didn't really touch it. Gave us a close above the high of the low day. Right there, that would have been our hold day. Yesterday didn't do a lot, just kind of flat. Today it's up a little bit, meaning kind of confirmation of this move up. Now, it's not guaranteed to move up, but we're looking for things that maybe could give us an idea about it. Now, this one on the implied volatility, you can see how high it was up here. It looks like that was about 1.17. Right here, it's about 0.93. So this stock is volatile. And we go over to the trade tab and take a look at this. What are we going to see on its beta? Yeah, its beta is almost twice, I should say. 1.98. Okay, so the S&P moves a point. Joby stock, on average, for what it's doing, it would move about $1.94. Okay, and that can be in either direction. All right, and then look here in the implied volatility ranges here. See how those are really high. Some of those are super high, right? 132%, 93, 102. These monthly ones, 97. So these are pricey options. So even though the price of the stock is lower dollar, the price of those options are going to be a little bit more pricey just because of that implied volatility that's priced into them. So let's go ahead. Let's take a look at this. And let's see if the strikes I was looking at here, this one, I was looking more at a selling strategy. Okay, taking advantage of this rich premium. We could sell a put outright, but I was looking to do a put vertical on this one here. So looking to put in here 16.15. So our 16 strike price, look at this, you guys, it's a 24 delta. Normally we'll target a high 20 delta, maybe a 30-something delta. And I started there, but the return, because those premiums are so rich, like, well, we can still get a good return if we come out of the money a little bit. And probability of expiring out of the money at this point is about 68% from the get-go. So it kind of shifts a little bit to say get paid well, have a higher probability, go a little bit further out of the money. Right? We would want the stock to stay above 16. We sold that 16 strike price. It's already at 18. So it's already $2 and some change above that. Okay. Would this give the stock some leeway? Yeah, it would. That 16, I'm going to put it as close, well, it's in that range, 16, 14. That's at close to 16. We would want it to stay above there. In the last few days, that's exactly what it's been doing. Okay, so we're looking at it from a technical perspective, looking at the beta, expecting a big move. So let's put this on here, 16.15. Let's see if this still gives us a trade that, so we're going to change that to 15 here, gives us a decent credit. Now I'm going to come over here and lock it. 27 cents credit on a $1 white spread. For you, is that a good enough return? For me, let's see how close these numbers are. Actually, these numbers are pretty similar to what they were earlier today. 27 cents divided by our max theoretical loss of 73 cents, which is a buck minus 27 cents, is giving us about a 36% return. So that is really, I'm going to say, a healthy return on something that's a little bit more out of the money. And we're taking advantage of that because the prices of the premium are richer. And therefore, we're going to go with a selling strategy here. Do you have to? No, you could do any other strategy that you wanted, right? Another bullish strategy. Options are not that pricey. $1.75 by $1.85, just a 10-cent spread on this. And there's 6,000 contracts. So if somebody wanted to just go long, you absolutely could. When prices are expensive, sometimes it's helpful to do verticals. That's why some traders go to that. Now, somebody wanted to do and talk about stop losses on a spread. And then there's a kind of a follow-up question Ken had here. Ken said, is it a bad thing to place a stop on options? There's pros and cons to everything, right? There's limitations and virtues. We put in a profit target on our first trade, right? We said, hey, if we can capture a chunk of that premium, let's grab it and go. Let's add it, right? Recognize that gain. If we don't sell it or don't buy it back, but we're not recognizing the gain, we're kind of waiting. Now on this, would we be happy to get out early? We might be. Where are their earnings? Okay, they're out here a little ways into August 6th. So we've got 2.5 weeks. Could the stock hit that target by then? It could. We just looked at a couple of our trades we did on Monday, and they'd already hit 2 out of the 3 had already hit their target. So it could happen, and it could happen with a volatile stock. We'll see. If the implied volatility continues to drop a little bit because it's bullish, that would help a short put vertical, wouldn't it? Yeah, I hope you're thinking through that. You're like, yeah, that would help that kind of a trade. So let's see if we get a chunk of it. Okay, your chunk might be different than your neighbor's. Okay, if we have 27 cents, and we could say if we get, let's say in this case, we get 75%. If we get 75%, only 25% is left. So let's multiply this by 0.25, and we're going to say, let's go buy it back at 6 cents. We'll just take the profit, no questions asked. Now, how many contracts can we do here? We're risking 63 cents here, I believe. 63 bucks. We could say, let's go $400 on this one on our position sizing. $400 divided by 73 says we could do 5 contracts. So we're going to do all 5, okay? We're not planning for this to be like a home run hitter, but we are planning on this to just kind of be a base hit and hoping, we don't know if it'll happen, but we're going to try to lock in those profits. So let's do our first trigger sequential, create our opposite order, and let's go buy it back at 6 cents, lock that in, and let it go execute the order for us if indeed that does happen. All right. I'm just going to check and see if we can get more of a credit just for fun. Look at that, 30 cents. Oh, that's nicer. Let's go for the 30 cents here. All right, we're going to confirm. We're going to hit, look at something real quick here. Yeah, we're going to go ahead. We're going to hit send after I put it in our bucket. All right. John says, could you recalculate and explain the percent profit? Yes, let's do it. Let me do this again. And I forgot to show you the buyback order if you wanted to put a stop on it. So let's queue this up again. Let's put it at our 16.15. There's our 30 cents. I'm going to lock it in. Let's suppose if you had the idea that, if it goes against you, you want to get out of the trade and you do want to put a stop on it. You can do that. There's some people that do like to trade that way. Some people, because it's a hedged trade and we've sold one of those options, some people prefer not to do that. They're like, it's a high probability trade. Let's give it the room to wiggle around. And because it was a high probability trade, we're going to count on it to do what we expect. We don't know if it will, but say if you were uncomfortable, let's do this. What if we go first triggers OCO and I create 2 opposite orders here? We've already submitted our order, so this is just to demonstrate to you. We had said go buy it back at 6 cents, so that would be like our limit order here. The one that we just submitted would look like this. And then what if it went against you, the amount of the credit you thought you were going to bring in? What if it got against you, 30 cents, and went up to 60 cents of value? Then yeah, you could put a stop there. We'd change this from a limit to a stop. We could put it good till canceled. Okay, so you could do that. The other question that we And then it would be, does it hit the target profit first or does it hit the stop loss first? Okay. A couple of sessions back, I taught you, maybe it was last Friday. I taught you how to build a custom template for a scenario. If you're somebody that does the same thing all the time, you always get out at, say, 75% of the max gain, which is what the 6 cents represents. And you always get out if it goes 100% against you. You could build a little template and just pull it up and use it every single time. Where can you find that? Let's head over to our Trader Talks channel. There's a couple things I wanted to show you here. First thing that I wanted to show you, and then I'll show you where that particular session is some of you are going to ask, and you may have the question in here, might not. The question comes up frequently, where did I get these stocks from that we're using today? Okay, where I got them from is what I call my early morning mover scan. It's something that I post about typically in the morning on my X account, see which stocks are coming up in it. And I created one of these bite-sized videos to show you how you could create it. Okay, and I also told you a little bit in there, maybe some of the parameters that I vary a little bit, depending on what the market's doing. So see this one that says instant watch list bullish, stock scan early morning, and then you can't see the rest of it. It says movers. That's the scan where I teach you how to do that. Okay. Let's go to the playlist and let's go find our short verticals class, which is going to be down here just a little bit. And let's see. Short verticals is right here. And let me move my mouse out of the way. We talked about doing a watch list in our short verticals class. I was telling you, I showed you, I guess maybe we'll have to go trading a smaller account and go back to Friday. We're not really looking to see that. But let's see where it was. I thought it was in our trading a smaller account class on Friday where I taught you. I apologize. I thought it was in this class. It could have been in another class that I taught you how to build that custom template. I might have done that in the short verticals class. If you were somebody that does the same thing every time, let me go into that short verticals playlist, because it must have been on Thursday that I showed you that. So how to create a custom template for your spreads. Okay, you always do the same thing every time and you wanted to know how to automate it. That's where you can go find it. Okay, so it's in the short verticals class. It's not in our class that we had here. Now, coming back to the question about how do you get out on a study? Somebody said, can you get out based on a moving average doing something? Yes, you can. And what I'm going to do is I'll just change our stop order here. Okay, I'm going to go into the gear. And on the gear, we're going to say submit when Joby, the stock. Then you can come in here and select on study. And then there are a lot of studies in here you can use. It just shows you 3 that are pretty common. Okay, so this one is a simple moving average. And then what you can do is you can go in there and change it. I was looking at what the default moving average is. I'm not seeing it there. You would put in what that moving average is on that study. Let's go study here. Let's go edit. And all right, if the simple moving average, so we're going to edit the condition, that's where you would put in how much of a moving average. Do you want it on a 20 moving average? The default period here is 9. Okay, but if you're like a 50 or 30 or 20, whatever it happens to be, you put that in there. And that, if it goes down there 1 tick, well, actually, that's not true. It's going to base it off the closing price. If it's below it on the closing price, then it would trigger that. Okay. Don't have time to go into all of those details. So we're going to go cancel, 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 cancel. All right. Hopefully that answers the question. John said, can you explain the calculating of profit? Okay. Now let's back up a moment here. Let's come back to this trade that has, we were working with it when it had 27 cents. Okay, so that's the number I went with. And then after we'd done all our calculations, I said, let's see if it's trading better than that. We can get filled higher, great. And it was. So we'll go back to the 27 cents. Okay, the credit here, that's the most we could make in the trade, is whatever the credit is that comes in here. And so what we were doing is we were saying on this particular scenario, on a put vertical, we collect the premium up front, and then it gets paid into our account immediately. Nice, right? That doesn't happen on every kind of trade, but it does on short verticals and selling an option. And then we said, okay, if we get most of it out of there, you know, when I'm using my toothpaste, man, I'm squeezing every little last bit of paste out of the tube. But that's not always the best approach with verticals, because sometimes then you're risking a lot more than what it's worth for risk. And so what we're saying here is, if we get the majority of this, if we get a chunk of this, and I think in this case I said, hey, let's do, if we get 70% of it, if we get 70%, then sitting out here basically says, if it gets down to 30% of what's left of this option, then that's when we go buy it back. So I multiplied 0.27 times 0.3, because then 30% would be left if we've captured 70% of it. I think it was 6 cents when I did it here the first time. Let me just do 0.27, or I might have used a different percentage. I think I did 70, but let's multiply that by 0.3. Okay, that's at 8 cents. So I must have used a different percentage. So you're taking whatever's left. What is it? Let's go buy it back. We're not trying to get all the toothpaste out of that spread. We're just trying to get the most of it and move on and lock those profits in. Because the trade isn't truly over until it's expired worthless. You go and buy it back for either a profit or a loss, or it's assigned. Okay, those are the three ways the possibility of the trade could work out. So I hope that helps for what that question was about, explaining the calculation there. Paul has a different time frame that he likes to use on short verticals. Paul, I appreciate you sharing that. He said not to use the OCO on options. They aren't guaranteed. The canceled order will still fill. It should, on an OCO order, it should take whichever calculation it comes to first. It can't come to 6 cents and 60 cents at the same time. Can't do both, right? So if that spread whittles down to 6 cents, great. We're going to be happy to get out of there. And I was just using this as an example. Okay, if it goes against us about the same amount of the spread, because we would have collected 30 cents, and now if it's worth 60 cents, man, it's gone the opposite direction. You know, our net on it there would be minus 30 cents. That would be the loss on it if we were doing it that way. So it should execute whichever condition comes first. The bottom order will be a limit or a market order, so we don't know what the exact price would be on this one. Hopefully it'd be close to 60 cents, but we're not guaranteed at 60 cents. Okay, hopefully that clarifies. All right, well, my time is up here, you guys. You have been asking some fantastic questions. I think as you ask those questions, it helps everybody understand the strategies better. Looking to see if there's any questions in the chat that I missed, but I am not seeing them at the moment. Brent, these guys kept you pretty busy out in the chat. I appreciate you helping to fill those questions. Now, we'll follow up on these trades when we'll see what happens today. We're going to find out on Monday what's going on. Now, that some of these new trades from today, long put vertical, short put vertical, we didn't get through all the trades I wanted to do, but those two new ones, they might not move a whole lot by Monday, but we can check the progress on our other trades that we have out there, the ones we did last Monday and the ones that we did last week as well. All right, you guys, coming up next is going to be advanced charting techniques Ben Watson's going to be teaching that class today from Cameron. Ben always does a super job with his technicals. So take a quick little break and we'll see you back at the top of the hour, everybody. If you haven't subscribed, be that subscriber. Follow Brenda and I on X. And if this is helpful to you today, hit the thumbs up button. Again, I didn't see a survey. Thanks, everyone. Bye-bye.